Hello and welcome to the ACT Annual Conference from wherever you're joining us today. Our theme for the conference this year is Balancing Risk, Championing Sustainable Growth. And when we set the theme almost 12 months ago, it in many ways seemed that the world was a relatively predictable place. The title of this session, Navigating Uncertainty, the Path to Recovery, demonstrates just how wrong that assumption was. If nothing else, the last 12 months have demonstrated just how essential it is for corporates to keep on top of events and stay current with risk management techniques. And I'm delighted to be joined by a team from Lloyds who will spend the next 45 minutes providing some insights into not only what they're seeing in the markets that you as treasurers interact with on a daily basis, but also provide some thoughts about how one might develop an approach to managing risk in such rapidly changing environments. Before we get going, just let me say, please do submit questions as we go along. And if we don't actually address them during the presentation, then please go to the interactive chat wall on the Lloyds exhibition stand, where the speakers will be available to answer questions following this session. Right, let me make some introductions. I'm Sarah Boyce, and after 20 odd years of working in corporate treasury, I am now a member of the policy and technical team here at the Association of Corporate Treasurers. And today I am joined by Amit Goyal, who is a Director of Corporate Solutions, by Sam Hill, who is Head of Market Insight, and by Greg Meier, who is Head of Capital Structure Advisory. Amit, to give you a little more background, works in the team that provides strategic risk management and accounting analysis to corporate clients. Sam is the economist of the gang, and Greg is head of Capital Structure Advisory team, focusing largely on debt and ratings advisory. So that's more than enough from me. I'm going to hand over to the experts. So perhaps, Sam, you could start us off with some scene setting.
Thank you, Sarah, and welcome everybody. Well, taking up the title of the path to recovery, I'd like to start by showing a slide, the first chart in the pack, which is literally the path to recovery. And here, this is using the example of the UK. And so what this chart shows is the size of the UK economy on the vertical axis, as an index level over the last 20 years on the horizontal axis. And what you can see here is that at the trough of the lockdown period, the economy shrank to a size that was roughly comparable where it was in 2002. But already, as far as the end of July, what we've seen is that the path to recovery has taken the UK economy more than half of the way back to where it was at the start of this year before the COVID-19 outbreak. That means there's still clearly a long way to go, but in some sense it's at least good news that over half of the lost output from the lockdown period has been recovered already. And actually, if you want to extend the theme of optimism, then just recently we've heard from the Bank of England chief economist, Andrew Haldane, and he's suggesting that actually by the end of Q3, by the end of September, when we get the data for that, it's possible that the economy will be just 3 to 4% below where it was at the peak at the start of this year. Of course, there's still some uncertainty about that, but it suggests that the recovery has continued. So in that sense, the path to recovery is underway, but picking up on the other feature of the title, Navigating Uncertainty, if you just look at this chart and see the difference between the June 2020 level of output shown by the pink dotted line and the July 2020 level of output, within 1 month, the economy expanded by about as much as it did in the whole of the recovery period from the global financial crisis of 2008 and 2009. And that recovery took 3 to 4 years. So there's clearly uncertain times if the economy is changing in size in 1 month by about as much as it did in the 3 to 4 years following the previous recession. So that gives you a very introductory feel for the theme of the path to recovery and navigating uncertainty. And to extend that theme, if we move forward to the next slide, please, we can see how the COVID-19 recession compares to previous recessions. What we've got here is a chart showing the depth of the last 5 recessions and the number of quarters that it took for output to return to the pre-recession peak. And what you can see here with the pink line, the COVID-19 recession, is that this is a far deeper trough in output than those we've experienced before. But also that if you follow the Bank of England's projection, the dotted line on this chart, it's likely that it's going to be a far steeper recovery initially, at least. But the challenge for the rest of this year and for next year is going to be that even if this relatively steep recovery that we've seen so far continues, we're likely to be left in a position where the recovery is still, or the hole that the economy is in, is still going to be roughly as deep as the average recession of recent history. So we still might be 4 to 5% below the pre-recession peak, which would be a trough as bad as the worst part of recent recessions. So still a long way to go. And so I think from the perspective of macroeconomic policy making, there are big questions here, not just for the Bank of England, but also for the government in terms of what they do with fiscal policy. We just saw the Chancellor's winter economy plan recently, and the introduction of a new scheme there to support the labour market. But there's likely also that there's further measures on the way to guide the economy through the rest of the recovery back to full pre-virus levels. But if we turn for a moment back towards monetary policy and consider what might one of the things that's been talked about is the possibility of interest rates being set at a negative level. And if we go forward to the next slide, we can get a feel for market expectations of interest rates. And this chart shows 3 paths for the market implied expectation for interest rates over the next 5 years along the horizontal axis. And you can see that the darkest green line, the one at the bottom here, is from late September. And it shows that the market did have an expectation that the path of interest rates would be below zero from about 1 year out all the way to almost 4 years out, even if only modestly negative. And that's quite different, you can see, from that period earlier in the year in March, when Governor Bailey was sounded much less keen about the possibility of negative rates. So, I think one of the big debates is going to be, will negative rates come about or not? Many people will possibly wonder, what would be the rationale for a negative interest rate? Does it even make sense? Well, I think some of those people who would say that it's a good idea would put forward the argument that if you have negative very short-term rates, which is what the policy rate would be, then it does have the potential to feed along the term structure and result in lower long-term rates, and that might be something that would have a benefit for a range of borrowers, and if they can get access to cheaper financing, then that might have broader macroeconomic benefits. So whilst that's one of the benefits, there are other potential costs. For example, it may be that it's difficult for negative rates to be passed on widely through the economy, and that might cause all sorts of difficulties for the banking sector and have unintended consequences. So all these issues have got to be worked through by the Bank of England, and it's far from clear yet whether or not they will go down the path of negative rates, but it's one potential policy option and fits in with the idea that there is uncertainty here to navigate. One of the other big questions on the policy front will be at what point, if at all, the Chancellor decides that it might be time to tighten the purse strings and take back some of the fiscal policy stimulus that has been widely acknowledged as necessary over the last few months. I think if the economy were to disappoint and if we were to take a relatively long time to recover to the pre-virus levels of output, then it is likely that some fiscal tightening would be necessary down the line, either in the form of spending cuts or tax hikes. But I think that's probably a story maybe for later 2021 or early 2022. So there are lots of policy questions to think about. And on my final slide, there's just a list of other considerations and risks that are around which don't just apply to the UK, but apply more broadly globally. And I shan't go into detail on really any of these, but I think if you just look at things like, how might news of a vaccine development impact market sentiment, possibly positively on the one hand, but how might the trade wars, the ongoing issues around US politics and the election, as well as some of those other things on the list, you can see that there are plenty of issues for markets to grapple with that will determine the outlook. For now, and this will be my final point, whilst there's all sorts of issues for markets to grapple with, it does feel as though central bank intervention in the form of large-scale quantitative easing has been one thing that has tamed markets by and large, certainly in terms of bond yields and in terms of supporting equity markets. That central bank intervention has been crucial, and that is expected to continue for some time. And so despite all of these uncertainties, that key role by central banks is likely to be one of the relative strong points and underlying continuous sources of support for markets as we go forward for some time. So I think at that point, maybe I should pause and hopefully have illustrated the uncertainty that needs to be navigated and that at least we are on the path to recovery partially at this stage.
Sam, just before Greg has a word, on the central bank intervention, is that something that we've seen on, has that been pretty universal? Or is it very much a sort of UK Euro type issue?
No, I mean, I think it's I think what we saw in March was there was sort of fairly simultaneous intervention across the board. So the Fed in the US engaged in an open-ended quantitative easing program. And the ECB in the euro area launched their pandemic emergency purchase program, and that was, as I say, at a similar time to the Bank of England launched its QE program. And I think as much as anything from a UK perspective, it benefits from the stability brought by those larger scale programs from the other central banks. And so whilst there wasn't explicit coordination, it was clear that all of these central banks were thinking along similar lines, that a large-scale intervention was needed to bring stability, and certainly they achieved that. And so I would think that we're not just talking about a UK theme here. It's likely that the Fed and the ECB and other central banks indeed will continue along the same path. So there's been relative synchronicity across the developed central banks here.
Good to hear that they can actually coordinate internationally when they really, really need to.
Yeah.
Anyway, thank you for that. I think, Greg, you were going to give us a bit of a journey through what you're seeing around capital structure.
Capital structure and funding strategy. Yes, a long title. Thanks. Thanks, Sarah. Thanks, Sam. A really succinct summary of both the past and maybe a view into the future. So if we turn to capital structure and funding, I guess the first thing to say is, at Lloyds, we are fortunate enough to have a significant presence in the UK corporate landscape. We offer an array of different financing options, capital markets, private placements. We provide a substantial amount of credit. What does all that mean? It means we have the enormous privilege of having a huge number of conversations with different clients about their experiences and trying to help them navigate the times we live in. So what I wanted to do in the next few minutes was effectively 4 things and some brief slides. First of all, I wanted to look backwards and share some of the themes that have been part of the sort of conversations we've had over the last 6 months in the eye of the storm, as it were. Second, I wanted to share a model that we use in discussions with some clients as we try to help them and help ourselves think through that nirvana of what is the ideal capital structure or for any particular company in any particular situation. Then, as we look forward, having sort of taking it from that model, thirdly, I wanted to look at what are the themes coming out of discussions as we then look forward and start planning for the next 12, 18 months and beyond. And then finally, to make it a little bit more practical, I wanted to sort of distill those themes into what I view, rightly or wrongly, may be a good sort of checklist for a corporate treasury community in terms of the things one needs to be thinking about. And they're also a checklist for credit analysts at banks or rating agencies as well. So with that, if we move on to the first slide, which I can see we have. So if we look backwards, certainly conversations over the last 6 months have all been about protecting businesses from the storm that we've seen and that Sam illustrated so well. And when I think of risk management, and I think of risk management in the broader sense, including sort of financing and working through the right capital structure, I view it a little like gardening. So I think it takes constant work, constant tinkering. It's about reacting to things outside our control, but also focusing on what we can control and watching the weather relentlessly, the weather being my metaphor for the economic backdrop that Sam has outlined for us. And so as we've been doing that gardening, I think the first thing to say is liquidity has clearly been key. I mean, you see some of the themes on this slide. So cash was clearly viewed as safer than RCFs. We saw significant drawdowns of RCFs. I think there was a natural concern about some of the reps and warranties and so forth on drawdowns. So despite the negative carry costs, we saw sort of liquidity being drawn down, and that has partially reversed. There have then been a lot of wider challenges. So obviously the rating agency actions have been overwhelmingly, as one would expect, skewed negatively. So have bank credit models and changes there, and the likes of credit benchmark and data and so forth bear testament to that. And then also financial planning, whether that's in a treasury team in a corporate setting, or whether that's the sort of modeling one might do in a banking environment and assessing credit, is it's stymied by huge uncertainty. So there have been real challenges there. There have been some unexpected sort of not necessarily silver linings, but slightly more positive aspects than we were expecting. I think the first is that while credit has been constrained for some, the public markets have certainly been more robust than I think many of us expected in the early days of the crisis. I think and hope, others will judge this better, that banks have been very supportive, and public policy has certainly been tremendously supportive. I mean, tens of billions of government support through the lending schemes, CCFF, and then all the sort of JRS, VAT deferrals, and so forth. And then in addition to all that, what you see here is that there have been, many of our clients have been pulling a number of strategic levers. So and one reads about this every day in the papers. So capital expenditure budgets have been cut, M&A activity has been with certain exceptions sort of dampened, and shareholder returns have been cut. And through it all, I think the critical piece has been very open dialogue with banks and rating agencies, which has been super helpful. So that's the kind of looking back, but undoubtedly clouds still remain. So I mean, I think that there was a recent report. I won't name the author, but it wasn't Lloyds, that talked about 100 billion of excess leverage or excess debt in the UK corporate space potentially, and undoubtedly leverage is higher than it probably needs to be medium term. And bank return models as well as their risk models are clearly ongoing potential constraints in some situations, and financial planning remains difficult. I mean, I think it's I don't think any of us view the future with a huge amount of certainty. So with that in mind, it feels like quite a difficult backdrop to then say, let's pivot towards the present and say, one's trying to work through the optimal capital structure. How could one approach it? And perhaps if we could move on to the next slide. Great, thank you. And I think I think my key point and the sort of overwhelming theme I want to stress is that I think it's transparent and thoughtful planning is absolutely key. And that planning, this is a diagram we use to talk through some issues, but planning always starts with strategy and strategic goals focused on a really honest, refreshed approach to the internal and external realities facing any particular company. And then look, from a financing perspective, the focus on future cash generation, business growth, shareholder returns needs to be brought together and reset into a refreshed financial policy. And I guess that would be my second biggest takeaway from this, that I think a creditable financial policy is so critical, and it will drive and optimize financing access, as well as being a good foundation for sort of risk management thoughts that Amit will come on to. So having done that, having rethought about strategy, having set the financial policy, inevitably it's slightly iterative with what is financeable. And so what is capital structure? I view it quite simply and through this diagram as the expression of financial policy derived itself from strategy in a manner that allows for a sustainable fundraising strategy. And I guess that's the key takeaway. So the question is, what financial policy achieves strategic goals, but also delivers a sustainable financing strategy? So that's probably enough sort of theorizing or modeling, as it were. Perhaps if we move on to the next slide, what I wanted to touch on next, third point, was as we have those conversations across many clients, obviously every sector is different, every client is different, every situation is different, but there are definitely themes, and at Lloyds we've sort of pulled out 5 themes that we see as sort of the themes of the next 18 months and probably far beyond as well. And they're not rocket science, they're not new. There will be many other pieces of this conference that talk about some of these points. But if I just touch on each briefly, I think the first thing to say, looking at the first point, is that planning for black swans definitely needs to increase. So the business environment remains volatile and is expected to remain volatile relative to recent historic precedents. And therefore, I think that the focus on liquidity and robust liquidity and definitely an increase in equity and equity akin financing is a reality. And I think if you look year to date at sort of 15 billion sterling odd of equity raised by corporate UK, it kind of bears testament to the fact that's real. I think the second point I raise here is and this is perhaps difficult for me to say from Lloyds, but I think banks always at least aspire to be strong partners. I know there's lots of thought about how well we do that, but we certainly aspire to be strong partners. But our capital is ever more expensive. Structural appetite is always going to be limited in some cases by maturity or for particular products. And so looking to the capital markets, looking to private placements, looking to perhaps new forms of capital is I think it's what I'd call a sort of re-enlightened theme from the financial crisis 10 years ago. But that sort of debt diversification, I think, is key. And then thirdly, resilience. I think resilience is a massive issue for all of us, both personally and corporately, whether it's IT infrastructure, managing, working remotely, and so living with the reality of the tragedy of COVID day by day, but also in a corporate and business sense. It's that resilience in the working capital ecosystem that I think is uppermost in many people's minds and really needs focus. And I'm sure there'll be lots of others that talk about sort of the debate around onshoring the global supply chains, vertical integration, partnerships. But whatever the ultimate truth in all of that, and however it plays out, I think resilience remains the key driver, because broken supply chains, non-viable customer propositions is clearly got to be a real focus. Then fourthly, sustainability. Obviously, lots written about this, huge area. It's a lag factor for some, it's an opportunity to lead for others. But I think whether it's sort of societal attitudes, public policy, investor, staff, customer, supplier demands, undoubtedly, our view is that the future will favour those that are proactive. So the time to act on it is now, and some of the standards and KPIs and so forth are still being formed. And then finally, I think that the fifth point is one that one can sort of almost forget at one's peril. But I think public policy will continue to be a much bigger piece of the future than maybe it's been in the past. So we could pick the trains because it's perhaps our favourite UK topic after the weather, and we've already discussed the weather. But we could also pick the insolvency regime, the elephant of sort of higher public sector debt that Sam touched on, and the challenges that presents. We could even talk about sort of societal inequalities and the sustainability of those. But I guess it's the same recurring theme. The future is less stable, and probably, while sector-specific aspects are key here, public policy will play a greater role. So I hope that helps. That is a sort of distillation of the themes. And then, conscious of time, if we move on to the final slide, I think if one tries to turn those sort of themes into something that looks a bit more like a checklist, and here you see sort of six topics that I almost view as sort of a template for a treasurer's notebook, and it's certainly, speaking for myself, I think in current times, a template for a credit analyst's notebook, and it will certainly form part of sort of credit applications in any bank to look at these aspects, and you see that you can start to think about them in very, very practical terms. So that while people have moved on from kind of crisis liquidity management, that continuing focus on what is the right level of liquidity for my business, and whether that's to exploit opportunity or whether it's to kind of fix the roof while the sun's shining, as it were, will continue to be a focus. Debt structure, capital allocation based on sustainable financial policy and a well thought through funding approach, absolutely critical. Resilient working capital, we touched on, really makes the difference in a crisis. And then the ESG agenda and public and I would say more active public policy, I think, are here to stay. So I hope that helps. It's there's a whole risk management piece that is far more technical and beyond my understanding, that I'm sure Amit will be about to touch on. So I'm sandwiched between two technical experts. So none of what I've said is rocket science, but I hope it helps set the scene and give some colour for some of the conversations we've had.
No, and certainly from a corporate treasurer's perspective, because a lot of us aren't technical experts either, to be clear, it's incredibly helpful. And seeing sort of suggested ways of thinking through what is a very challenging environment are very helpful. So that's those. Your last two slides in particular, I suspect, will be referred to quite a lot over the coming months by a number of people that are listening to this session. So thank you very much indeed for those. Amit, you work as, as Greg says, you're one of the technical experts, and you're in the financial risk advisory side. So what sort of questions are corporates bringing to you at the moment?
That's a good question, Sarah. And before I answer that question, I think it'll be nice for me to talk about what's been going on in the market, so I can give the answer appropriate context, if that's okay.
Oh, that's fine by me.
Okay. So if we can then move to the first slide on the risk management, please. So there has been a clear dichotomy in markets, as you will see in just a moment. So on the top left, I have included the 5-year swap rates in the 6 major currencies. As Sam mentioned, central bank support after the crisis was quick and substantial. And what it did was not only to compress the cut down policy rates to historical lows, but the central banks gave clear indication as well that the rates are likely to stay lower for a longer period of time. That, combined with the asset purchase programs, means that the longer end of the curve has come down as well substantially and compressed across a number of currencies. The other thing to point out over there is that not only the curve has flattened, the swap rates have more or less flat-lined. There is a distinct lack of volatility in interest rate markets right now. And although the swap rates have been trending slightly lower, for example, on the back of the negative interest rate policy talks and discussions by the Bank of England. So lack of volatility in swap rate markets, flat curves, and historically low interest rates. Now, on the second chart, we have the overnight rates, as well as the sterling LIBOR rates. Just after the crisis, you can see that there was a period of disconnect between the LIBOR rates and the overnight rates. This was on the back of concerns regarding bank liquidity, but because of the liquidity pumped into the system by central banks, and also because of the substantial deposits by households and corporates as well, those concerns have largely dissipated, and those LIBOR rates and overnight rates have more or less converged. LIBOR rates have come down, which also means that the amount that corporates are earning on their deposits is close to zero or even negative in certain cases. So that was about the interest rate markets. The key theme is low rates and a lack of volatility. FX, on the other hand, is a story in contrast. Especially pound sterling has been the world king amongst the major G4 currency pairs. Sterling has been the world king ever since the 2016 referendum and continues to do so. In the peak of the crisis in March, we saw the cable wall rise up to 19%. Euro sterling was not far behind either. Over the course of the summer, the volatility normalized, came down substantially. And many corporates actually took advantage of this as well, because this volatility was present in the intraday moves as well. So a lot of corporates took advantage of it by making use of limit orders to hit aspirational levels. But volatility tends to, even after the normalization, it tended to be still high around key event dates, for example, the US presidential elections. So right now, the 1-month volatility is higher than the 3-month volatility because of the additional event risk around that. I mean, having said that, sterling has had a very good summer. It rose to 135 from against dollar from lows of around 115 during the peak of the crisis. Against euro, it strengthened up to 112, and it had an extremely good August as well. But there was a sense that the market was being a little bit complacent about Brexit risks that were just around the corner. And we saw at the beginning of September, when the internal market bill was introduced in the parliament, not only did the volatility increased for sterling pairs, the risk reversals increased as well. Risk reversals, as you know, is a gauge of the relative demand between sterling downside protection versus upside participation. So that moved, so suddenly there was a significant demand for sterling downside protection as a no-deal Brexit risk became real. And, you know, over the last few weeks, the key driver for sterling has been Brexit headlines, as we saw on Thursday as well. with the EU initiating legal action against the UK, and there's slightly different mood music coming out of two negotiation camps. We are seeing wild swings in sterling on the back of Brexit headlines. So clearly a lot going on in the financial markets right now. And now coming to your question, Sarah, I want to talk about two key themes that I'm seeing that we are seeing from clients. And so first one is on the next slide. Cash is king, enough said. Greg mentioned that earlier as well. A number of corporates have been building war chests, increasing their liquidity and cash buffers, either drawing on RCFs, going to capital markets, or making use of government schemes where applicable. So corporates have a significant amount of cash at the moment, and for good reason, to help them navigate these uncertain times. What I would like to point out, though, is that corporates went into the crisis already having a significantly high proportion of fixed rate debt, as you can see from the schematic on the top right. The amount of fixed rate debt as a proportion of total debt has been increasing across sectors in the UK corporate space over the last 5 years. For one simple reason is that the carry benefit of swapping to floating has not been as significant as it used to be before 2016. So corporates have been more fixed, and now with a lot more cash in hand, it has thrown up some interesting situations. For example, a FTSE 250 client with a significant amount of fixed rate debt, now with a lot of cash as well. Combine the two together on a net debt basis, this corporate has about 150% fixed. So which begs the question, and a lot of corporates are in a similar situation, which begs the question, is this where corporates want to be? I mean, there are no easy answers, unfortunately. I mean, clearly cash is there for a reason, but it comes with a cost of carry. So I think it is a good time for corporates to look at ways to mitigate this cost of carry. Some corporates, especially in cash generative businesses, have looked to swap some of the fixed rate debt to floating. Although the carry pickup is small, every little bit helps. And not just swap it to floating, even in some cases considered swapping it to overnight rates just to get a head start on the IBOR transition. So that is one thing that a lot of corporates have considered, especially those who have a cash generative business. There are other ideas as well. So if a corporate is agnostic whether they are fixed or floating on a portion of their debt, some corporates have looked to monetize that. And other corporates have looked to consider the cash pile in conjunction with their existing derivative portfolios in order to get some pickup and extract some value out of it, just to mitigate this cost of carry. Rates are going to stay low for a long period of time. Corporates are not earning anything on their cash. So it is, I think, of key importance to look at ways to optimize the loss of carry on this cash balance. So that one theme. The other key important theme that we are seeing in the UK corporate space is regarding forecast uncertainty, which is on the next slide. So I start off with a comment from Governor Bailey that he made during his testimony to the Treasury Select Committee on September 2nd. He mentioned that MPC had built a record level of uncertainty, the most in the past 25 years, in their future projections. And not only that, he reckons it will be quite some time before this uncertainty is unwound. So with the onset of the crisis, corporates have faced a significant amount of uncertainty, supply uncertainty, clearly demand uncertainty, and also significant uncertainty in the markets, especially due to a number of event risks on the horizon. I mean, cable is an interesting example because the cable are more or less binary. I mean, in a COVID-induced recessionary environment, if there is a no-deal Brexit, levels around 120 or lower are unlikely. On the other hand, if there is a Brexit deal. Any deal, no matter how bare bones, combined with improvement in risk sentiment, optimism, or good news on the virus side, 135 is within reach. And actually, cable did almost touch 135 just on dollar weakness. So the risk is quite binary on the financial market. So what should corporates do about? I mean, before we look forward, it will be prudent to look back. In the initial response to the crisis, as far as their FX hedging portfolios are concerned, corporates used a variety of different approaches to manage their portfolios. A lot of corporates right-sized their hedging book to get rid of any excess hedges, terminated some of the hedges where the exposures were not likely, or roll over some of the other hedges where the exposures are now delayed, or even restructured them. Now, as corporates are taking small steps, cautious steps towards business as usual, the question is, what should they be doing? Should they be hedging less? Should they be hedging more? I mean, there is an argument either way. I've been speaking to one large UK corporate who mentioned if cable was to fall below a certain level, their business model could be unviable. So why hedge at all? The response to that would be, well, you hedge because hedging will buy you time to make certain strategic changes in order to keep your business going. On the other hand, there have been situations where clients have been saying that if I hedge more, it is possible that we can end up in a situation that we are overhedged. Well, that is possible if you continue to use traditional methods like forwards. UK corporates have traditionally not liked options, which provide flexibility. But some corporates have used the learnings from the crisis and started looking into options more earnestly, and because that allows you to manage your exposures in a much more flexible manner. There are reasons not to use options, but there is only one good reason to be using options in this time, because corporates can use all the flexibility they have to deal with the uncertainty. So those were the two key themes that we are seeing from clients, and hopefully, Sarah, that answers your question. I'm just going to move on to the next slide and spend no more than 30 seconds on it. So corporate treasuries have been working very hard over the last few months, dealing with a number of challenges, but a number of challenges lies ahead as well. And I'm not going to preach to the choir anymore, but here is a very simple checklist just to have in the back pocket. Let me go through it really quickly. Number one, continue to understand your exposures, especially to key event risks on the horizons. Run stress tests, even run war games, and please plan accordingly. So that's number one. Number two was review hedging strategies. Simply assess their suitability to the new world and whether it meet the near-term or medium-term objectives of your corporation. The third one, and the most important one, is flexibility and adaptability. Cash might be the king, but flexibility is the key to navigate through uncertainty. And finally, relationship with the banking group. As Greg mentioned, proactively engage with the relationship banks. We are here to help. Use us not just for funding and hedging requirements, but also use us for insight support and any analysis that can help you make the right decisions. That's it from me.
Amit, that's great. Thank you very much indeed. As you're aware, we've run out of time, as we often do in these conversations. Thank you all very much indeed. Everybody, please, you can watch this session back again. There's lots of really valuable information in it. I would counsel that you definitely revisit this session. Also, please remember that to pay a visit to the exhibition hall. As I mentioned earlier, the speakers will shortly be on the Lloyds stand. If you'd like to ask them further questions, please take the time to fill in the survey that accompanies this webinar. It's very helpful for all of us. Finally, I'd like to thank Sam, Greg and Amit for a very fascinating 45 minutes. Thank you and goodbye.